Hello everybody, today will be my first video dedicated to market analysis and specifically technical analysis. I have about 10 to 15 years of background as a technical analyst, and technical analysis has helped me to catch the market bottom in August 1998 and allowed me financial independence for some years. I was caught out by the 2000 bursting of the tech bubble, but then I learned new lessons and I rebounded and managed to recover. And during the credit crunch of 2008, I was able to pick a lot of good stocks at bargain levels, as well as buying some mutual funds. So I'd like to share with you what I've learned, and it is a continuous learning process because nothing is ever a sure bet, but to me it's just a question of probabilities. So your risk-reward ratio is relevant. I'll start by analyzing the American equity markets represented by the Dow Jones Industrial Average as well as the S&P 500 index. To me, the Dow Jones is constrained by a possible head and shoulders top pattern developed throughout most of last year. So in order for a bullish scenario to be confirmed, the neckline that you see drawn in red will need to be penetrated and perhaps tested once before the market can resume and maintain a sustainable rally. However, based on my analysis of the August 1998 bottom, which allowed me to catch many equities at a very low price, I believe that we had developed a similar pattern during the September to October route, as you can see here. So in future videos, I will use red to indicate resistance and bear factors, while green will be used to signify support and bullish factors. As for the S&P 500 index, which is more reliable, it is constrained by the same neckline as the Dow, but it has bullish RSI, stochastics and MACD indicators, as you can see. And over the medium term, you can see the following bullish factors indicated in green, as well as bearish factors indicated in red. And over the long term, I compare the current period to the period in the past in 1974 to 76 as indicated, and there is a 60% likelihood of a further advance from here and a 40% likelihood of a drop for a few months before a resumption of the rally in the style of 1976 to 1981. The main group that will support the S&P 500 and Dow will, in my opinion, be the technology sector, represented here by heavyweight IBM, Microsoft, and perhaps Intel. So you can see the charts of IBM and Microsoft, and of course McDonald's, which seems to be on a tear here, hitting new all-time highs. And most Dow stocks look quite strong technically, and Alcoa recently released its earnings numbers, and that is supportive of the stock, which is also a Dow component, and I think that Alcoa is bottoming at the moment. As for the volatility indicator, the VIX, which I use to great effect to time the market bottoms of 2010, and also to help me to pick the September 26 bottom last year, it seems to be on its way to trending down slowly. So although many analysts predict increased volatility, I believe that will only come much later in the year. There is a rally to be caught, as suggested by the technical picture of the VIX. Now for the specific emerging market that I invest in, which I am not at liberty to review, I have two stocks which I recently entered in January. I did enter a position in late December that is already up 14%, a long position, and I just yesterday entered a long position in two other emerging market stocks, which I shall call PN2 and PZ0. So for PN2, here are the charts that influence me to enter. So the bullish factors are indicated in green, and the bearish factors are indicated in red. And the bearish line, red line, can also be target to realize any profits. But right now I'm holding on firmly. So within a day it has performed as such, PN2 that is. So it seems to have validated the technical picture. If you wish to discover the identity of these stocks, as well as if you require individualized analyses of markets and particular stocks, please contact me privately for the subscription packages that I offer. Thank you so much for watching.